Every week, we see the same story unfold. A DSCR deal that looked bulletproof suddenly starts crumbling mid-process. The borrower thought everything was lined up, rent roll solid, LTV within range, FICO good, and then, out of nowhere, the underwriter says the ratio came in under 1.0. That's when the panic sets in. Calls start flying. What happened? We're already in escrow. The truth is, DSCR loans don't fail at the finish line. They fail the moment no one anticipates the variables that can flip the ratio upside down. Let's start with the first deal killer: coverage collapse. Most investors assume DSCR is just rent divided by mortgage. It's not. It's the lender's interpretation of that math. And every lender runs their own formula. Some use note rate, others the qualifying rate, and the more conservative ones add taxes and insurance into the numerator. That small change can take you from a 1.15 to a 0.95 overnight. Smart borrowers don't fight it, they pivot. They know which lenders calculate off interest-only payments or allow blended income from short-term and mid-term rentals. A ratio that fails with one lender might qualify perfectly with another. The numbers didn't change. The underwriting model did. Then comes the rent gap trap, the most misunderstood killer in DSCR lending. Appraisers love market rent. The problem? Market rent is a theoretical average. It ignores the lease you actually have. So if your tenant is paying $3,000, but the appraiser says market is $2,400, your entire DSCR falls through the floor. When that happens, you don't argue emotions, you bring data. Show rent history, signed renewals, bank deposits, or verified STR income. Better yet, move the file to a lender who accepts real-world data sources like AirDNA or third-party rental platforms. This isn't gaming the system. It's correcting it. Next up, vacancy and stabilization risk. A property at 80% occupancy can still perform, but traditional DSCR programs penalize it heavily. If you're mid-turn, mid-rehab, or in lease-up, the file dies. Unless you switch to a bridge to DSCR structure, one that lets you close vacant, stabilize, and refi within 6 to 12 months without starting from scratch. And that leads us to the most overlooked part of this entire process: timing the pivot. The biggest mistake investors make is loyalty to a failing file. They see red flags, lender delays, revised LTV, rent recalculations, and they still wait, hoping it'll clear. That's a rookie move. You never wait for a denial when you can move for a rescue. Transferring your appraisal, rerunning DSCR on a different model, or pivoting to a hybrid program isn't disloyalty, it's survival. Some lenders have the same guidelines on paper, but radically different interpretations. Knowing who still funds low-coverage deals at premium pricing, or who will count STR income without 12 months of history, is how professionals close when others walk away. Let's be clear, sometimes it's not the numbers, it's the narrative. If your file is presented as risky by the first lender, it gets tainted in underwriting notes. A clean restart with the right structure can change everything, especially when you move from retail underwriting to private or wholesale channels. That's where flexibility lives. Now, if your DSCR ratio is below 1.0, don't assume it's over. You might just need to reposition the deal, extend the IO period, increase rents on renewal, or add a co-borrower with parallel income streams. In certain cases, we even recast it as a business purpose loan with blended collateral coverage. The key is speed. The longer you wait, the fewer options remain. Here's the hard truth. DSCR loans are math, not emotion, but the people who interpret that math, the underwriters, appraisers, credit committees, are human. And that's where most deals are either rescued or buried. If you're in that gray zone right now, your DSCR fell short, the appraisal missed, or you're staring at a lock about to expire, don't waste another day hoping it'll fix itself. DM us your DSCR deal. We'll tell you exactly where it broke, what options still exist, and how to save it before the lock expires. Because in this business, the difference between a failed file and a funded one isn't luck. It's strategy.